Imagine you kept 10,000 rupees in a locker today, and 10 years later, when you open the locker, you find only 2,000 rupees. Where did 8,000 rupees go? Or let's say you had kept a 100 rupee note under your bed in 1958, and today you find only 1.20 rupees in its place. Where did 98.8 rupees go, right? Well, the answer is inflation. If inflation constantly steals the value of your money, how do you safeguard your wealth? नमस्कार दोस्तों, स्टॉकल के इस नए एपिसोड में आपका स्वागत है। As we are well aware, the prices of crude oil are rising and consecutively the petrol and diesel prices are also inflating. Not just that, but the prices of all other goods and services are also slowly witnessing the rise. This rise in price is called inflation. As an effect of inflation, the value of money depreciates over time. So, how does one protect it? Is there a solution to that? Well, yes, there is a solution. In today's video, we shall talk about an instrument called TIPS bonds that protects you from inflation. लेकिन आगे बढ़ने से पहले अगर आपको हमारे ये वीडियोस पसंद आते हैं तो प्लीज कंसिडर गिविंग देम अ थम्स अप. We come up with new videos about global investing every week. You can subscribe to our channel and press the notification bell to ensure getting updates. And if you have any queries, you can comment below and we will surely solve them for you. So let's go ahead and take a look at what exactly are TIPS bonds. TIPS stands for Treasury Inflation Protected Securities. It is a security issued by the U.S. government, especially designed to protect investors from the rising inflation, or you can say to protect from the diminishing purchasing power of their money. With rise in inflation, TIPS bonds का principal amount भी बढ़ जाता है to match with the real value of money. Since the principal value changes with inflation, the interest payment also varies since it is based on the principal amount. तो ये कैसे काम करता है? Well, the amount you originally invested gets adjusted with the inflation. Let's take an example to understand better. Suppose you invest 1,000 rupees in TIPS bonds with a 1% interest rate per annum. If there is no inflation, you shall receive 10 rupees as interest. However, if there is 2% inflation, then the principal amount of 1,000 rupees will rise to 1,020 rupees and you will receive an interest of 10.20 rupees, which is 1% of rupees 1,020. Now let's assume instead of 2% inflation, there is 3% deflation. That is, the prices came down by 3%. Now the principal amount will get adjusted from 1,000 rupees to 970 rupees and the interest will come to rupees 9.70, which is 1% of 970 rupees. That's right. It is important to note that since the TIPS bonds adjust its principal with inflation to protect investors, they usually offer low interest rates. TIPS bonds are issued by the U.S. Treasury Department with multiple maturity periods such as 2, 3, 5, 7, and 10 years. Their purpose is to mainly reduce the effect of inflation on portfolios. Therefore, if inflation does not exist, then this investment might not perform excellently. Hope this video helped you understand the working of TIPS bonds issued by the U.S. Treasury Department. As inflation is on the rise, many investors are now considering diversification towards globally secured bonds like TIPS, which are backed by the U.S. government. Whether you're planning to invest in stocks or bonds in the US market, you definitely must download the Stockal app from iOS App Store or Google Play Store. While we come back with another interesting episode for you guys, please subscribe to our channel and hit the bell icon so you don't miss out on any updates. Until then, happy investing.